what is the mood like? This is a mid-cap conference, and mid-cap is where there is opportunity, and mid-cap is where there is fear. So in general, are you getting a sense that their fund managers are hungry for ideas, or right now mid-cap is a dirty and ugly word after the recent sell-off?
I think the participation clearly, underscores the point that there is a reasonably high level of interest. We have almost all the top domestic funds and a reasonable participation of FI investors as well at the event. And even the corporate participation is across sectors from IT, pharma, engineering, financials, logistics. So to the event clearly symbolizes that there is still high amount of interest in understanding businesses and how incrementally businesses are performing. I think given the recent sell-off that we have seen, definitely people are clearly looking at adding companies which are available at reasonable valuations, though the valuations have not really gone into a despair zone yet, but they aren't as expensive as they were earlier as well. And there is still quality stocks are still symbolizing a huge amount of some amount of premium as far as valuations is concerned. But nevertheless, I think clearly there is good interest to look at quality names at the current point in time.
That indeed is the case. Kashyap, as part of the Rising Stars conference, what is the pet theme that you're propagating? Because there's been a fair amount of sell-off in the mid caps and the small caps all of this month.
So, the underlying theme which is clearly emerging is to stick to bottom-up ideas, and this is not going to be a year where top-down is going to work. Like if you look at 2017, your time in the market and allocation to the market was more important than what sectors or what stocks you were in, because as long as you were there in the market at the point in time, which is 2017, and you had allocation in equities, more or less everyone had a healthy share of performance. As compared to that, this year is going to be a bit different because you have macro headwinds in the current year on the back of rising, crude or worsening currency, election tail risk. So to that extent, you are definitely seeing PEs compress. So even though we have seen many companies deliver inline performance, we are still seeing the multiples that those companies which used to trade at say 1 year back versus what they trade at now has actually undergone a change. So this is the year where the theme is going to be more bottom up. It's going to be more looking at how each businesses are doing and what is a sustainable growth rate or longevity of revenue stream that they have over the next 3-4 years, and whether the valuation is comfortable to look at the current point in time. So I think that is one of the key themes that will play out. It will be more bottom up. And second would be to stick to quality, because historically, if you see in India, actually what has really worked is quality stocks, and investors have been able to give couple of quarters of pardon if the numbers don't come in some of these high quality names as well. So unlike some companies who are clearly punished if the earnings don't come or if the commentary is a bit weak, quality companies to that extent have been able to get that level of go through that level of doubt that even if the earnings don't come or are missed 1 or 2 quarters, there is still a level of comfort in owning those names, and those are the names which have actually seen the highest amount of PE expansion in the last few years. And what has really worked is quality stocks. So the factor, even at the current year, given that we are going to be seeing an election tail risk which would pan out towards the year, and the macro is a bit weak compared to the last year, the theme which will be looked at is quality companies. So bottom up and quality investing is what we see investors sticking to.
Kashyap, good to see you after quite a long time. This is Siddharth joining in conversation. You said top down may not work this year, and generally top down is the approach when is adopted when there is gush of liquidity which is moving into any market. Do you think liquidity would be difficult to come by in our markets, and that's the reason whatever little liquidity which would come, it would be more stock specific?
So the interesting bit about liquidity is that if you look at the flows this year, since Jan to May, the FII flows have been negative $140 million, and maybe that would be the highest amount of outflows which one would have seen in, from CY 11 till date. Now, during the same breath, if I see the mutual fund inflows have been positive, maybe $5 or $7 billion thereabout. So, and that would be maybe the highest amount of inflows within a period from CY 11 till date. And on an average, we are seeing $1.8 billion of inflow from domestic mutual funds in the markets, and we are seeing a monthly outflow from FIIs of $20 million to that extent. Now, so clearly we, the FII liquidity, having shrunk or FIIs being underweight India is not something which is new at the current point in time. It's been there, but the domestic inflows have been strong enough to basically compensate that issue. And the sense that we are getting is that the domestic inflows will continue to look at stock specific investments, and you do have a good amount of new paper also which keeps coming in every year, and some of the new businesses also get a huge amount of participation. So could be like Bandhan Bank, which saw stupendous participation, to names in the insurance side which actually saw a good amount of participation. So the good thing is that we've seen quality paper also come out in the market, which has been able to absorb some of the incremental flows that have come to domestic mutual funds.
Very